Learning outcomes. After studying this module, you shall be able to learn about the organization and objective of LIC and GIC, study the various plans and policies offered by LIC and GIC, understand the investment pattern and policy of LIC and GIC, study the regulatory framework of insurance industry covering Insurance Act 1938 and Insurance Regulatory and Development Authority. Learn and differentiate various types of insurance intermediaries. Introduction. The insurance sector is massive and is growing at a fast rate of 15 to 20%. Along with banking services, insurance sector contributes approximately 7% to the India's GDP. A well-developed and advanced insurance sector facilitates economic growth and development as it provides access to long-term funds which can be used for development of infrastructure and also strengthening countries' abilities to take risk. Insurance industry in India, depending on subject matter of insurance, can be classified as life insurance and non-life, that is general insurance. Under the life insurance, a specified amount becomes payable after the death of the insured person or upon the lapse of a specified period of time, whichever is earlier. Whereas in non-life insurance covers losses caused by accident, marine, fire and so on. Until 1999, the insurance organization in India comprised two institutions owned by the state, the Life Insurance Corporation of India or LIC and General Insurance Corporation of India or GIC with its subsidiaries. The insurance sector in India has grown through reforms after the recommendations of Malhotra Committee. The Parliament introduced the Insurance Regularity and Development Authority Act in December 1999. In April 2000, the IRDAI became a legal body and since then it has been making rules and getting the private sector insurance companies registered. In August 2000, the insurance sector was opened for the private sector. As a result of reforms of the insurance sector, today there are 24 life insurance including LIC and 28 non-life insurance including GIC in both public and private sector. Now we will discuss upon Life Insurance Corporation of India. The first is organization and objectives. Life insurance was brought to India from England long time back in 1818. Europeans began the Oriental Life Insurance Company in Calcutta as the first company of life insurance. Bombay Mutual Life Assurance Society started first Indian Life Insurance Service Company in the 1870. Indian citizens were covered at an average rate. Before 1912, India did not have any legislation to manage business of insurance. It is in 1912 when the Provident Fund Act and the Life Insurance Companies Act were officially approved. The Life Insurance Companies Act of 1912 mandated that the periodical valuations and tables of premium rate of companies have to be certified by an analytical expert or actuary. But the act was biased towards foreign companies on many accounts, which put the Indian companies at a disadvantaged position. Now we will discuss upon the organization of LIC. The demand for nationalization of life insurance industry had been made many times in the past, but it actually gained importance in 1944 when a bill to revise the Life Insurance Act 1938 was forwarded in the Legislative Assembly. Although it was much later, on the 19th of January 1956, that life insurance companies in India were nationalized. There were approx 54 insurance companies of Indian origin, 16 non-Indian companies and 75 Provident were operating in India at that time. The Indian Parliament passed the Life Insurance Corporation Act in the 19 June 1956, and in September 1956 the LIC was created with the objective of increasing the life insurance by going deep into the rural areas and reaching all insurable people in the country, offering them financial cover specific to their requirement in an economical manner. Today, LIC functions with more than 113 division-based offices, 2048 IT branch offices, 1274 satellite offices and zone-specific offices, and the corporate office. LIC's wide area network covers all these divisional offices, and all the branches are linked through a metropolitan area network. LIC continues to be the most trusted life and dominant insurance provider even in the liberalized competitive scenario of Indian insurance, and is moving fast, rapidly breaking its own record of the past. LIC has issued more than 1 crore policies in this year till now. From where it started, LIC has come a long way and has set surprising performance record in various areas of life insurance. The registered office and headquarters of LIC is located in Mumbai. Now we will discuss upon the objectives of LIC. They can be summarized as: spread the word of LIC, particularly targeting rural areas and socio-economically weak classes with a view to reaching all potential population in the country and providing them relevant financial cover against loss of life at competitive and affordable cost. Maximize movement of people's saving by making insurance linked savings a major chunk of people's life. Manage business with utmost loyalty and answerability, having full realization that the money belongs to the policy holders. Act as trustee for the insured ones who need aid, doing all under their individual and collective capacity, keeping up with changing demands and needs of the community arising from ever-changing social and economic scenario. Participation and determination from all associated people working together under LIC to serve the community of insured people with courtesy and understanding. Next, we will discuss upon the types and structure of insurance plans. The corporation has introduced several kinds of insurance policies. There are few basic types of very popular policies are term insurance, whole life insurance, endowment policy, annuity contract, individual insurance, group insurance, pension plans, children plan, and equity linked plan. These policies are mostly specific to different income and age group. Life policies of any times can be either with profit or without profit. In without profit, the sum paid out on maturity or at death is the amount assured of the policy when it was laid out. In with profit, bonuses out of extra earning from various investments are added to the assured sum periodically during it currently or occasionally paid out in cash. The premium on with profit policies are higher than those on without profit policies as an allowance for the bonuses paid. Seen as a financial instrument, life policy grants access to a claim in future leading to either lump sum or an income stream. The value of a certain policy equates to a lump sum or income stream less the value of premiums to be paid in future. It is possible to withdraw the policy by A. Surrendering the policy for cash, B. Forwarding it in open market, C. Raising loan with the policy as security, D. Converting it into free or paid up policy. In many cases now, the provision of life covers becomes a subordinate motive, while the other motives are more important even when taking up a policy to ensure one's life. About 18% of LIC policies are protection policies, while saving policies are about 60%. It has a share of 94% in endowment products. it has an outstanding claim ratio of only 0.67%, which is arguably regarded the best in the globe. It tops in the speed of settlement of claims. In the term of total business, the individual insurance continued to be predominant. It accounted for about 82% of the total sum assured and premium income. Under individual insurance, two plans, namely endowment assurance and money back policies, accounted for approximately 80% of the total insured sum each year. The next is valuation of policies. The funds collected from the sale of life plans are invested in a variety of income producing assets. The life fund is built up out of the surplus premiums and investment income above claims and expenses on revenue and capital accounts. The life is valued from time to time by discounting future income and expenditure back to present. The rate of discount used is generally equal to the rate of interest which the fund's assets are expected to earn on the average. An allowance may be made of increase in interest rate, future bonuses in the case of with profit policies while determining the discount rate. A life fund is in surplus if the valuation of fund is greater than the present value of liabilities to come. This surplus is available to certain extent for policy holders and partly for adding to reserves. Only with profit policies involve the distribution of surplus. There are three basic methods of distributing surplus to policy holder. They are in the form of cash, as a reduction in premium, and as an increment in the value of policy. The later form of addition to the value of policy is called reversionary bonus. The bonus may be declared as a simple reversionary bonus computed on the original amount assured, or a compound reversionary bonus which is computed on the original sum assured plus any bonuses already declared. The next in discussion is investment pattern and policy. The provisions of Insurance Act 1938 have governed the pattern of investment of LIC funds. LIC funds are invested mainly into three categories. First, government and other approved securities. Second, loans to state government for housing and water supply schemes. Municipal securities not included in above. Government guaranteed loans to municipal committees and cooperative sugar factories. Third, approved investments which included shares and debentures of public and private limited companies, of cooperative societies, immovable property, loans to its policy holders, and fixed deposit with scheduled banks and cooperative societies. The next in discussion is General Insurance Corporation of India. The first is organization and objectives. Contracts of insurance which do not come under the scope of life insurance are called general insurance. The different forms of general insurance are fire, marine, motor, accident, and other miscellaneous non-life insurance. General insurance is a policy of insurance that safeguards the holder against damages and losses other than the ones covered by life insurance. The roots of general insurance business in India can be traced to the Triton Insurance Company Limited, the first company of general insurance which was established in 1850 in Calcutta by the British. The Indian Mercantile Insurance Limited, which was set up in the year 1907, was the first company to transact all classes of general insurance business. The next are the objectives of GIC. GIC aims at achieving the vision to be a leading global reinsurance and risk solution provider. The important objectives of General Insurance Corporation of India as a reassurance company are building long-term mutually beneficial relationship with business partners, practicing fair and just business values and ethics, application of state-of-art technology processes including company risk management and innovative solutions, develop and retain highly motivated professional team of personnel, enhancing the profitability and financial strength. Next is the structure of business. The essence of general insurance is the collective pooling of risk arising from fortuitous occurrences. The policies hardly run for a period more than 1 year and there is no guarantee of renewing of policy on the same conditions or any terms. The general insurance companies gather pools of funds from investment income and premium income from which they meet claims under the policies. Since nature of their liabilities is short term and claim against are unpredictable, their assets are kept in liquid form. The general insurance companies are also called property and casualty or liability insurance companies, and they specialize in insurance in such area as hail, fire, ocean and inland marine, aviation, automobile, theft, damage, loss, etc. The GIC and its subsidiaries also do business of insurance in these types. They have introduced some new non-traditional schemes of insurance for purposes which are important in the Indian economy. Agriculture insurance benefit from the insurance coverage at economic cost. It has been promoting personal insurance in the areas of poultry, livestock, pisciculture, sericulture, pump sets horticulture and personal accidents. Recently, it has introduced new policies as follows. Personal policy for accident for visitors in premises of the bank, professional indemnity insurance, insurance against contingency and liability for members of joint stock companies and stock exchanges, rejection insurance on marine products, nuclear insurance pool for insurance of nuclear power plants and nuclear related risk, insurance of hut, personal accident insurance social security scheme. Other activities include GIC Mutual Fund, GIC Grahvita Limited, National Insurance Academy and Loss Prevention Association of India Limited. Regulatory framework of insurance industry. Now we will discuss upon the Insurance Act 1938. The insurance sector went through a number of phases from being completely unregulated to being completely regulated and then to the current scenario of being partially deregulated. The Indian Life Assurance Companies Act 1912 was the initial statutory step to manage life business. In 1928, the Indian Insurance Companies Act was brought to help the government to collect statistical data about both life and non-life business carried out in India by Indian as well as foreign insurance, also including the provident insurance societies. In 1938, so as to protect the interest of the insurance public, the earlier legislation was strengthened and altered by the Insurance Act 1938 with extensive provisions for control over the insurance activities. The important features of the framework present in the Act are eligibility for carrying on insurance business, registration, accounts and balance sheet, actuarial report and abstract, investment of assets, insurance business in rural social sector, investigations, issue of directions. Now we will discuss upon IRDA, which is Insurance Regularity and Development Authority. Insurance Regularity and Development Authority is an independent apex legal body which manages and develops the insurance industry in India. It was constituted by an act passed by the Parliament named Insurance Regularity and Development Authority Act 1999 as per the major recommendation of the Malhotra Committee report on 7 January 1994. It recommended setting up of an autonomous regularity authority for sector of insurance in India. The main aim behind it was to safeguard the interest of the holders of policies, to manage, promote and ensure uniform growth of industry and also to revise the Insurance Act 1938, the LIC Act 1956 and the General Insurance Business Nationalization Act 1972. The agency's headquarters is located at Hyderabad, Andhra Pradesh. Earlier it was located in New Delhi. Now we will discuss upon the duties and powers of IRDAI. Section 14 of IRDAI Act 1999 lays down the powers, duties and functions of IRDAI. The authority shall manage, promote and ensure uniformly growth of the insurance and reinsurance business. The power functions are: issue a certificate of registration to the applicant, modify, renew, withdraw, cancel or suspend such registration. Safeguarding the interest of the holders of the policy in matters which concern assignment of policy, insurable interest, nomination by policy holders, surrender value of policy, settlement of insurance claim and other terms and conditions of insurance contracts. Specify required qualifications, practical training and code of conduct for intermediaries and agents. Specify the code of conduct for loss assessors and surveyors. Promote efficiency in the working of insurance business. Promoting and managing professional organizations associated with the insurance and reinsurance business. Imposing fees and charges for carrying out the objectives of the Act. Specify the format and way in which books of account shall be kept and statement of account shall be presented by insurance and insurance intermediaries. Manage investment of funds by insurance companies. Control maintenance of margin of solvency. Now some salient features of the IRDAI Act 1999. The first schedule appended to the IRDAI Act stated several revisions to the Insurance Act 1938. The second schedule to the IRDAI Act included Section 30A in the Life Insurance Corporation Act 1956, in which the exclusive privilege of LIC to carry on life insurance business in India was to end. The third schedule to the IRDAI Act included similar provision Section 24A in the General Insurance Business Nationalization Act 1972, whereby the exclusive right of the GIC and its subsidiaries in relation to general insurance business ended. All the power of the former COI under the IRDAI Act are shifted to and are now bestowed upon the IRDAI. The central government's powers related to the activities and working of insurance industries have been transferred to the IRDAI. The IRDAI can make Insurance Advisory Committee of 25 members to illustrate the interest of industry, commerce, agriculture, transport, surveyors, intermediaries, consumer, agents, etc. The next we will discuss upon insurance intermediaries. Insurance intermediaries are legal bodies and individuals who offer or end insurance contracts on behalf of the insurance companies. Insurance intermediaries include corporate agents, reassurance brokers and insurance brokers, surveyors, insurance consultants, loss assessors and third-party administrators. Third-party administrators and surveyors are not involved in procurement of business. Surveyors estimate losses for insurance companies. Third-party administrators provide health insurance services for insurance companies. Now we will discuss upon agents. An agent works for any one life insurance and one general insurance company. An agent is appointed in accordance with the regulation stated by IRDAI. IRDAI or an officer on its behalf will issue a license. The license may be to act as an agent for the life insurer or agent for the general insurer or agent as a composite insurance agent, which means agent for both life insurance as well as general insurance. Next is corporate agent. The provisions of appointment of an agent are applicable for the corporate agent. These provisions are subject to some additional provisions, which areas follows. A corporate agent can be only a company or a firm. For having a share capital of rupees 15 lakhs, the insurer can decide on basis of the particular case. A principal officer should be qualified as Associate of Insurance Institute of India, Mumbai. If a corporate is already in existence, then within 3 years from the date of renewal, the principal office should obtain these qualifications. The next is insurance brokers. The insurance broker is an expert and professional organization that deals with all insurance companies. Its area of operation is based on all India basis. The category of brokers. The brokers are categorized into 3 types. First, direct broker. They deal in life and general insurance business. The second is reinsurance broker. They deal with reinsurance business. The last and third is composite broker. They deal with reinsurance as well as life and general insurance business. Now the capital requirements. Any applicant who seeks to be an insurance broker should meet the conditions stated below. First, it should have a minimum capital of, for the direct broker category, it has to be minimum 50 lakh rupees. For the reinsurance broker category, it has to be 200 lakhs. For the composite broker, it has to be 250 lakhs. Second, for the company limited by shares and cooperative societies, the capital would be in terms of equity shares. Next, for other applicants, capital shall be in form in cash. No part of the capital of an applicant shall be held by a non-Indian interest beyond 26% at any time. In any insurance broking firm, a person named as principal officer would be held responsible for business of insurance and day-to-day task of broking firm. Now we will discuss upon surveyors and loss assessors. Loss assessors and surveyors provide services to a general insurance company, mostly at the time claims of motor or fire insurances. They carry out surveys of claim and assess the quantity of loss. Indian Institute of Insurance Surveyors and Loss Assessors was promoted by IRDAI under Section 14 of IRDAI Act 1999 and was incorporated under Section 25 of the Companies Act 1956. Any person who is a member of this institute and intends to work as a loss assessor and surveyor in interest of general insurance business would apply for obtaining of license to the authority in Form IRDAI 1AF given in these regulations schedule. The authority, while taking into the consideration the application, consider all matters relating to the responsibilities, functions and duties of loss assessor and surveyor. It satisfied itself that the applicant is fit and that license can be guaranteed. The next are third party administrators. Third party administrators were introduced by Insurance Regularity and Development Authority to introduce a new system of management and to regulate the cost and services of healthcare. Third party administrators are provide services to insurance companies for processing if the claims of health insurance and offer facilities like making cashless settlement of the claims. Now the conditions for third party administrators include: first, only a company which has a 1 crore share capital and which has been registered under the Companies Act 1956 can work as a TPA. Second, an organization wishing to function as TPA shall procure license from the concerned authority by making a written application in TPA1 form along with the fee of rupees 2 lakh. The authority, after examining the application and details given by the applicant, can issue a license if it feels that the applicant is eligible to work as a TPA. Every TPA who has got approval by the authority before grant of the license will pay an amount of rupees 30,000 to the authority as license fee. A copy of the agreement entered into between the TPA and the insurance company or any modification made thereof should be filed within 15 days of its modification. The license to act as a TPA shall be issued by the authority in Form TPA-2. The next in discussion is web aggregators. A company registered under Companies Act 1956, approved by the concerned authority, maintaining, owning a website, providing information related to products of insurance, making price comparisons of products of different insurance, and offering leads to an insurance broker insurer is called web aggregator. Now the conditions for web aggregators. The application for approval as a web aggregator shall be made by the applicant to the concerned authority along with a fee of Rs 10,000. It should be paid by means of a bank. Draft should be in favor of Insurance Regularity and Development Authority, payable at Hyderabad. It should contain information as mentioned in Form A. The approval granted by the authority would be valid for a period of 3 years from the date on which approval has been obtained. For the approval of the web aggregator, the applicant shall fulfill the following conditions. The applicant should be a company established and managed under the Companies Act 1956. The Memorandum of Association of the company shall state in its objectives web aggregation business as one of its prime objectives. The applicant shall have a net worth not less than Rs 10 lakh as on the date of application. The applicant shall not have any arrangement of referral within an insurer. The applicant shall not be registered as an corporate agent, insurance agent, TPA, micro insurance agent, surveyor, insurance broker or a loss assessor. While consideration of the application, the authority may choose to verify the information stated by the applicant, including the supportive documents, and can also examine the applicant's infrastructure and offices. The next is insurance repositories. An insurance repository is a facility which seeks to help holders of the policy to buy and keep policies in electronic form and not as a paper document. Insurance repositories like mutual fund transfer agencies or shared depositories hold electronic records of insurance policies issued to individuals. These policies are known as e-policies or electronic policies. Now the conditions for insurance repositories. Bodies which are approved by Insurance Regularity and Development Authority can become an insurance repository. Insurance repository can be set up by an insurance company on their own. They cannot hold more than a stake of 10% in any insurance repository. A policy holder shall open an e-insurance account known as EIA with one of the insurance repositories so that it can buy and keep policies in electronic form. With one insurance repository, an individual can have only one e-insurance account. Once this account is opened, the account holder can buy and keep all his electronic insurance policies, life, health, pension or general, issued by different insurance under one single account. Each EIA shall have a unique e-insurance account number. The account holder should be required to state this number in all interaction with insurance repository. Each account holder gets a unique login ID and password to access his account and view electronic policy details online on the website of the insurance repository. Now let us discuss what we have summarized so far. Insurance industry in India on the basis of subject matter of insurance can be classified as life insurance and non-life insurance. Under the life insurance, a specified amount becomes payable on the death of the insured or upon the expiry of a specified period of time, whichever is earlier, whereas non-life insurance covers losses caused by fire, accident and marine and so on. Oriental Life Insurance Company was commenced by Europeans in Calcutta. It was the first company of life insurance in India. The Parliament of India passed the Life Insurance Corporation Act on the 19 June 1956 and the Life Insurance Corporation of India was created on 1st September 1956. Various insurance plans of LIC are endowment plans, money back plans, term insurance plans, pension plans, micro insurance plan, group schemes, social security scheme, health plan and unit plans. The pattern of investment of LIC funds has been governed by the provisions of Insurance Act 1938. The GIC was formed in accordance with 9 subset 1 section of GIBNA. It was assimilated under the Companies Act 1956 on 22 November 1972 as a private company limited by shares. GIC was formed to control and operate the business of general insurance in India. The pattern of investment of GIC funds has been governed by the provisions of Insurance Act 1938. Its funds are invested mainly into following 4 categories. First, central government securities. Second, state government securities and other guaranteed securities. Third, housing and loans to state government for housing and firefighting equipment. Approved investment in infrastructure and social sector and market sector. IRDAI Act 1999 has a provision to amend the Insurance Act 1938, the LIC Act 1956 and the General Insurance Business Nationalization Act 1972. The powers of the central government relating to the activities and operations of insurance industries has been delegated to the IRDAI. Insurance intermediaries are legal bodies and individuals who offer or terminate insurance contracts in interest of insurance companies.